Right, guys. So did you learn anything?
Yes, we learned it so far.
That's fantastic. Okay. Now let's continue. So we're going to look main strategies. Okay, buy for dividend yield. Probably you know some people, high incomers, make $1 million a year, like doctors, solicitors. That's their strategy. They buy just long term, don't care about fluctuations. They just get dividends. Okay, so another one, buy low, sell high. Probably the most popular strategy on the stock market. The only thing you need to know what here.
When to buy.
When to buy and when to sell. Okay, that's the tricky here. Now, then buy shares and rent them out. And that's where you use options. And another one, third one, buy shares, insure them, and then to rent them out. So it's BIR strategy, we'll call it. Now, last two strategies, they involve options. Okay, who knows what option is? Have no idea. Okay, so I'll explain now.
Did you explain at the beginning?
I just explained a bit, yeah, but now I'll explain in stock market view. Now, let's have a look like that. Now, we're going to sell options. And remember, it's really, really important. When you sell, what do you get for this? Money.
Yeah.
Now, remember, always sell. Because when you buy, you pay. Okay? Now, you try to sell in order to get money. So that's the very, very important point. Now, when you're selling call option, you're giving the right to somebody, right, to buy from you an underlying product for the certain price before the certain day. With our land examples, what it was? It was a land. The owner of the land, the landlord, he sold for $50,000 the option to buy. If you don't come, he keeps this 50K. It's his money. He's still making money, right? If you buy, he gets another $2 million on top. Okay, so now, simple another story, not with a land, but with a bag. Imagine that you're a shop owner, and you sell a lot of bags. And usually this lovely bag costs $1,300, and you now selling it for $1,000 on a sale. Now, a woman comes, a lady, and she, oh my goodness, I love this bag, I want to buy it, but I'm not sure that my husband approves it, first of all, and I'm not sure that I have enough money, I have to check it. So can you hold it for me? What you will tell as an owner?
Give a deposit.
Give me a deposit, or in this particular case you say, look, I have only one bag, I can sell it next minute, so give me some, like $50 to hold it for you. So you get $50 holding fee for 1 week. You agree that she comes in a week time, within a week, and she buys it. If she doesn't come...
Yeah, but doesn't that $50 get deducted from the total price?
No.
Oh, in the retail it does.
In retail, yes. But in your case, what's Shamil, you say, no,
Yeah,
it's
that's why
holding fee.
I'm only just going in relation to what you're saying there.
Okay, so it's a holding fee. It's not the deposit, it's a holding fee. You just come, and if you don't come, this $50 gone. Because you, as a business owner, have a risk. You can't sell this bag for a week, right? Deposit, when she definitely comes and buy, but she is not sure if she's going to buy or not, right? So she gives you this $50 and telling you, look, just keep it back. If you don't come, sell it back. So basically what happens here, if she doesn't come with $1,000, she loses her $50. Now, $50 is the price of the option, or premium for the option. Now, she paid $50 to hold the right to purchase this bag. Now, important from her side, she doesn't have an obligation to buy. She doesn't have to buy. But you have to provide her this bag. You cannot sell this bag. So when she gets this right, you have to keep this bag for 1 week. Okay? Now, you make money anyway, because if she doesn't come, you have this $50 and you sell your bag after that. If she comes, she pays you $1,000. So it's regardless, you make more money with her rather than without her.
Yeah, but
How
after
you are
1
making
week,
more money if she's paying back?
So imagine that if you decide to sell, so for example, she doesn't offer you this deal, and she left, and you sold it for $1,000, how much you made?
1,050.
If she doesn't give you this deal, if you
Oh,
you say no,
Yeah,
like,
1,000.
1,000,
Yeah.
that's it. Next customer comes and you get $1,000.
Yeah.
Now with her, how much you're making?
1,050.
1,050. So you're better off to do this option, right? So that's why it's good for you. You got 5% extra.
Okay, so she has to pay if initially if you're depositing $50,
Yeah, in the
when she
retail,
buys,
it's
she
a
still
wrong
has to pay
example.
another 1,000, is it?
Yeah.
It is a-
Oh,
Yeah,
okay.
that-
Okay. So yeah, it's,
That one's a wrong. You
It's like
should
a
have
whole-
done a retail one because
It's like a
in
holding fee.
retail,
Yeah, it's a
the
holding
dollars
fee.
It's a
goes
holding
into
fee.
the price. But that example is a little bit.
But if the bag lose the value,
like yes, it can. So in this case, for example, you sell like we look at options like that. Very good point, actually. But in your case, for example, it's already on discount. Okay, so she knows she can sell it high. Now, key elements here. Just remember, strike price. Here, exercise price. It's $1,000. On stock market, it could be $10, $11, $12, etc., etc. Now, the premium, $50. Okay, or option cost, some people call it. Okay, so it's another thing. Underlying product. Here, handbag. On the stock market, it's some kind of share.
Yeah.
All right. Then expiry date, week later. On the stock market, usually on US stock market, it's the third Friday of each month. Okay, so on each third, so if you rent, I call it rent, your shares, it's until third Friday.
here Thursdays are last
Okay,
week.
here it's Thursday before last Friday. Okay, now then type of expiration, it's right to buy because put option. The only difference with put, it's right to sell, but we're not going to put options today, so not to confuse you. Now, basically, selling call options. Example with shares. Now, if you want to write it down, write it down. Now, imagine that you bought a stock for $10. The next, you sell call option for 1 month with a strike price of $11 and receive a premium of 50 cents. Now, buyer pays you 50 cents for the right to buy your share at $11 at any time during this month. Buyer believes that the share price will grow up, right? And they buy it at 11 and sell at whatever price will be higher. That's why they pay you this 50 cents. And we'll look at this, why they're doing it. There could be two outcomes of this deal. Now, we'll look at your calculations, and then we'll look at calculations of other person in order for you to understand why person is getting this. Because with property rent, it's normally like person moves and lives there, right? Why somebody is going to pay you money on the stock market? And we'll show it. Now, so you first buying and paying $10. The strike price, $11. Now, you can choose strike price higher, lower, or at the same level as you purchased.
How do you decide that?
And it's already, we discovered it in the course. You look at your profitability, how much money you can make, and depends on the trend and certain parameters, okay? And now, option premium. In this particular case, we got 50 cents. Sometimes it's 40, sometimes it's 60, so it could vary as well. And you always can see it on the brokerage option chain account. So two outcomes. Now, the first, the price stays below $11. It's never went above. So what happens in this case? What's your profit? You keep,
50 cents.
you keep 50 cents. Actually, this 50 cents, very important. You get it up front. So when you create this contract, you get this money. It's on your account. What can you do with it?
Invest it.
You can reinvest it. What can you do else?
Buy shares.
Withdraw it, go for holidays, to do something. That's your decision. So if
Can't go on holiday for 50 cents.
You know, I was gonna say, you can't even
but
get
imagine that
it
it was $100,000.
Example,
Yeah. Yeah.
So what if it is $100,000? How much it would be 50 cents there?
50,000.
$5,000. Can you go for holidays for $5,000?
And didn't you just say $100,000?
Yeah.
Yeah, if it's $100,000 and it's 50 cents.
On a share.
You talk about the shares are worth $11. Okay.
Yes. Okay. So you got it, right? So that's what your profit. Now, another interesting thing here, if you bought for $10 and you got 50 cents straight away, you brought your price what?
Yeah.
Average down, right? For 50 cents. Now your break even is $9.50. So anything above $9.50. So even if the share price dropped to $9.60, you're still making money.
Yeah.
Okay. Now, if it drops below $9.50, that's where you have capital loss.
Yeah.
But you lose money when you sell your shares.
Just,
Only. If you don't sell the shares, you don't lose the money. So if you bought a property for $500,000 and it's dropped in price to $450,000, do you lose money or not? No.
no, she
No,
says.
you keep
Until
renting,
you sell.
right? So what can you do if the price dropped here? What can you do?
You keep it.
You keep it, and what else? Can you rent it again? You
Yes,
can. You
and
collect
well-
another 50 cents.
Yeah.
And what else? then again 50 cents each
Well, if
month.
the price has dropped, you won't be getting 50 cents.
Maybe 40
necessarily.
cents, maybe 30. So it will change. Yeah, absolutely right. And
And then if it turns back around and you've created a price, then that you could risk.
so you have to know. Very good question. Yeah, I love it. And, you know, so you look it forward now. Absolutely right. So you need to know what strike price to sell, the premium, the duration. There are a lot of parameters there. But questions are really good because if the price is dropping, so you need to rather to get less a premium, maybe not 50 cents but 30 cents, or you reduce the strike price to $9.50. And of course here you use technical analysis and certain other parameters in order to identify the movement of the shares. Now, how many months, by the way, you need to do it? If, for example, share stays on the same level, doesn't move at all, let's say, how many months do you need to rent it if you get in 50 cents in order to cover your investment completely? 20, correct. So 20 months. Now, that's the advantage of combining value investing. So if you bought a stock and you were wrong and it doesn't go straight away, they didn't solve these problems, during this time you can keep collecting options.
So you can do this with any of that, any of the stock that you
Practically, yes. Not every company has options. You need to know which one, and we teach how to identify them. But yes, practically majority of big companies which we work with, they have this ability to sell options. So in this case, usually if you invest value moves, when do they happen? The big moves, they happen after earnings. When the management comes and tells, we had better earnings, we solved our problem, look at our results. After that, shares start moving up. So between them, 3 months, you can collect rent. Then earnings, you appreciate on value investing, on the growth, okay, and get your money already on the capital growth. That's how things work. Now,
How much investment you need to have a $100,000 option?
no, you can start from $2,000, $3,000, it doesn't really matter. The only thing here, you need to buy 100 shares.
100 shares.
So if you invest in shares which are worth $5, 100 shares, how much is that? $500. So that's how low you can invest and start doing it. Okay. Of course, here it depends on brokerage commissions because some brokers they will charge you regardless if you sell one option or 10 options, same price. And of course, it's more convenient to sell straight away 10 contracts. Okay, it's 1,000 shares on the lot. Okay. The second thing, if the share price moves up, for example, to $20, what would be your profit in this case? 50 cents which you received. And then the difference between $10 and $11, $1 profit. Okay, so altogether $1.50, which gives you 15% profit. But what happens here? You're back in cash. You have no more shares. What do you do after that?
So you're saying, sorry, so you're saying that if you write the option and then the stock price goes up, by the time that end of the third, whatever it is, Friday, you'll get the capital gain and the thing,
Absolutely right.
but if you've set a strike price at a certain point, you're agreeing to sell at that price, aren't you?
Correct.
Because you're doing that at the 11, that's what you're
Yeah.
saying.
Correct. So here,
But if it goes past 11, you won't get that.
No, you just.
that's where the point. You don't get extra profit, but you get profit regardless. And it is key, you need to understand. So that's why you need to have a plan before you do it. Rather you just keep it and happy to hold it for 2 months, 3 months, 5 months, 6 months without getting any cash. Or you want to get the cash each month, which you can reinvest, okay, but you have a risk that your shares can be taken lower than you have. And sometimes it happens to me. I sold stock at $45 level and after that went to 60. It can happen, but do you think it's good to have like 5%, 6% income every month? It's great, like regardless when the stock market goes up, down.
You're basing that on that the stock price is not going to go up.
But I think you showed only 2 examples. One where the stock going up, and the other one the stock price not going up.
Or stays the same or going down. You still get this 50 cents.
Oh, even if it goes down 50 cents.
You still have this 50 cents is paid up front. You still have it. You keep this money. So it's up to you. You can buy more of these shares. You can continue renting, whatever. Okay, so it's up to you. And I'll go show you one example now. Now, I want to explain you why another person buys options from you. And The risk here is only 50 cents. Okay, but 50 cents control $10. So it's like $500 controls $10,000. So the outlay is much smaller. Now, two outcomes. If the share price stays below $11, what happens?
He doesn't have to buy it.
He won't buy it.
No,
No, what happens with 50 cents?
he loses it.
He loses everything. Okay, that's the key. Everything. That guy loses everything. Now, if the share price goes to $12,
He just pays the $11.
he pays 11. He sells for 12. Usually it happens in one trade. He doesn't have to put this money, so it's in one trade. So $1 profit
Yeah.
on $50 outlay. The profit, like real profit, 50 cents,
Yeah.
100% within a month. That's why this guy is playing that. Sometimes they get 200, 300% a month. But if they don't do it, they lose everything. Now, if you go and type online how to make 200% or how to make 100% a month, you will get this. They will teach you this strategy, how to buy options. But remember, here there's chance of losing everything. In this particular case, regardless of movement, you still make money. Okay. Now the key here, I don't know your name, pointed that the share price can drop lower.
Yeah.
That's the first part comes, which I was talking before the break, value and buying only undervalued companies. You're already buying them when they're already low. Already the risk of going even lower, it's much smaller than the potential of going up. So that's the first key. Quality companies, secondly, undervalued, and then you do option strategies. Because majority of people who learn option strategies, they don't bother about first part, and they buy any shares at any price, and then of course they can collapse 50.
They can buy more risky stocks.
Yeah, and they
Because the profit is higher.
yeah, and that's the key. Always buy quality stock because it's always can recover even if it drops down, and when it becomes undervalued, because in this case the share price has less potential to go down. Now, okay, guys, real example. Okay, from last week, I just did a screenshot. And the reason for that, why I did it, one of ladies, she talked to me and she said she bought Rio Tinto. It's not I recommend Rio Tinto, it's again, it's just an example. She said she bought it at $70. And the price, last price, $29. So she lost, and she's sitting 3 years already on that. Didn't make a penny. Okay, like except dividend. Now, look at this here. 16 days until July. After when I did this screenshots. So 16 days, half a month. That's the option premium. That's the strike prices. You see, you can choose $20, $22, $25. I chose, the current price is $29.95. I chose $30. So just 5 cents above the current price. What's the premium? It's the last trade which was made. So $1.02. Okay. Now, if I got $1.02, divide by my investment, $29.95. It gives me 3.4% of profit for 16 days. Now, is it good?
Yeah.
That's a real screenshot. If we go to the market now, I can find you hundreds of examples like that. Now, if you have $100,000, how much is that in cash?
$3,400.
Yeah.
3,600. Now, Rio Tinto moved from that moment. Now it's $31. So these shares, if I did this trade, will be taken from me, and that will be my profit. If the share price stays below that, what I'll do? I'll continue doing it and collecting this type of money. For 1 month, you will get 5%, maybe
So
more.
then there's your risk. If you bought it for 17, it's now down to 20, and you're writing an option, and you're writing it for higher, and it does go up, and then the stock goes up, and you've now realised your loss.
Absolutely correct. So what can you do after that?
No idea.
You buy the stock again on the low and continue doing it. And I've done it hundreds
You're
of times.
saying buy it again.
Buy it again. You can buy the same stock, you can buy another stock. The thing is here, very seldom that the stock goes down all the way up. Usually it moves slower, and you can keep renting it and collecting. If she was collecting this for 3 years and was making $1 for 48 months or 36 months, she would collect all her money back already, long time ago. That's the thing. You need to keep following the strategy. And we'll teach you how to avoid this type of situation where you called out because you choose the strike price. In this case, I would go for $35 strike price or $32 strike price. I get 20 cents less, but I would get $2.50 on the growth. If I identify on the technical analysis that the range of movements, it's about from, let's say, $29 to $31, I'm safe, right? So if I use the strike price, which is above. Good question, okay? Now, that's the Rio Tinto. Now,